started. Ladies and gentlemen, good morning.
Morning.
Call the meeting to order. It is 9:45, and this is the New York City Employees Retirement System Investment Meeting. Today is April 23rd, 2013, and we are on the 22nd floor at 335 Adams Street in Brooklyn. Diane, would you please call the roll?
Chair,
Here.
Controller's Office,
Here.
Public Advocate's Office,
Here.
Borough President Manhattan,
Here.
Borough President Brooklyn, Borough President Queens,
Here.
Borough President Staten Island,
Present.
Borough President Bronx,
Here.
International Brotherhood of Teamsters,
Here.
Transport Workers Union,
Here.
District Council 37.
Here.
We have a quorum.
Thank you. And Larry, I will hand it over to you.
Perfect, thank you. Everybody have their monthly report?
Yes.
Excellent. I would say as an overview of 31 slides, the economy is percolating up, not at a very rapid pace, but percolating upward. So now if I can get you to page 32. You can see the NYCERS value at the end of February. It's 45.7 billion, highest it's ever been. March was a good month, so we're north of 46 billion. April, not so good month, but I think we're still over 46 billion. If you go to the next page, page 33, you can see a 10-year picture. Where's Bob North?
Right here at the point at the beginning and the
Okay. It's a bumpy ride, but it averages about 8.6% for 10 years. If you go to page 39, you can see that overall the month of February was a pretty calm month. If you look again over at the block of numbers on the far left, those are the February numbers. In general, the U.S. markets were up about 1%. EFA and emerging markets were down about 1%. Treasuries roughly were up about a half. High yield was up about a half. More interesting is the following month, which I don't have the numbers for yet, is page 40. The equity markets got excited. So again, the U.S. markets are about 4%. International markets were about flat. So was the U.S. government. So it was a risk-on kind of month. If you flip backwards to page 35, we haven't changed our asset mix at all. We're within all the bands. Again, we remain leaning into U.S. equities, leaning into high-yield bonds and leveraged loans, and leaving out of governments and tips. The combination effect gets you to page 41. Shows you we made about 63 basis points in the month of February, which brings the year-to-date number to about 10.4%, 8 months or 2/3 of the way through the year. The April number's good, so we're probably north of 12, plus or minus sort of for 3/4 of the year. So as long as the markets keep drifting about where they are, I think we'll beat the 7% net. One thing to point out that usually wouldn't think to point out is if you go to page 56, this is the monthly cash flows of private equity. Barry had a good month in that more cash came back to us than went into private equity. That's partly a function of IPOs and realizations and equity markets in general moving up, but that's a good thing because, again, it's an illiquid asset class. We're working our way. We're creeping up a little bit in our asset allocation, so now we're sort of crept back down. I wouldn't call it a trend per se, but it did give us cash in the month. Do you have any comments on it, Barry?
I think that's perfect.
Lovely. So that's the month. It was a positive month. Again, clicking along. March next month will be a good month. And again, I think the economy is percolating up. Any questions of the month? Perfect. So today we have a presentation on currency. We've been talking about currency on and off. Catherine and John Bright, I think, are going to lead us through this with Callan. Where do you guys want to sit? I guess you sit down there.
This is my entire contribution.
We appreciate that. But you're there for moral support.
You gave me all of them?
They'll come around. I have one in the book right here. There's one.
Push this behind, unless you like being short.
Pretty big. Take that everyone.
Oh, wait, I was just looking, I said, he's a tall guy.
Yeah, okay.
Thank you.
Hurry up. That's what I do best. Yeah, no, I got it. One.
Somehow they passed out tests more efficiently in grade school. I don't know why. Maybe that was more stressful. Whenever you're ready, ma'am.
So Callan is going to discuss the pros and cons of hedging a portfolio such as ours. What we as the risk team decided to do was to just set the stage for Callan by laying out some of the numbers so we can right-size the problem or the issue for all of you. Essentially, we've got about 16 to 17% of the portfolio in non-US dollar securities. And if you turn to the first page, this is based at December 31st. We had $44.2 billion in the fund. And as you can see, between EFA and emerging markets in the upper right-hand quadrant, we've got about 16% allocation. And that's mostly EFA and a little bit of emerging markets. That's all in public equities, and that is by far the lion's share of the exposure to the international, to the non-US currencies, markets. On the next page, we break out the total $7 billion, again, by asset class, and you can see that the fixed income, private equity, and private real estate are de minimis, and it's mostly coming from our emerging markets and public EFA allocation. Page 4 shows the regional breakdown, the lion's share being Europe and East Asia. And the breakouts are in the table to the right. And the last page shows us the currency and the breakdown by currency. It's roughly the same percentage of the portfolio. We just want to note that there are a number of different ways to look at currency exposure. This is actually in non-US dollars. It excludes things like ADRs that are in the other numbers. Yeah.
East Asia is what?
Japan, Australia, Korea.
Singapore.
Hmm?
Singapore? Singapore is southeast.
Southeast. Any other questions? With that, we'll hand it over to Mark. To Bud.
Good morning. Okay, so I'm going to continue on what Catherine just talked about, and my agenda starts on page 2. So we'll highlight these areas of why should plan sponsors consider currency management. We'll take a look at the historical perspective of returns and volatility from the currency markets. We'll talk about some ways to manage the currency exposures, suggest when the right time to hedge might be, and then take a look at what other plans are doing. And then if you have an interest, we can take a look at current conditions of the dollar versus other currencies. Flip to page 3. Why should plan sponsors consider currency management? First, it's probably a good idea to just take you through an example. And when you invest overseas, your total return is a combination of how the security performs and how well the currency performs. So let's take a quick example. If you have a stock you want to invest in Germany, and you have $100 US that you want to invest. First, you have to convert that into euros in order to buy the German stock. So for simplicity, let's just say the euro and the dollar are equal, 100 to 100. So when you first buy into the German stock, you're getting the same currency. $1 equals 1 euro. And say you want to buy a stock that costs $100 per share. So pretty simple example. Well, after the first year, the stock rises 10% in value. So now you have 110 euros. However, the euro versus the dollar also rises by 10%. So now you have a return that is 110 plus the 10, you have 120 euros. When you convert that back into US dollars, you are able to buy more dollars than you would have. So now you have a 20% return instead of a 10% return. And then the flip side of that can also work against you. When the dollar appreciates versus the euro, you can actually lose some of that return. So, as I mentioned here, the second bullet point, when U.S. investors, they benefit when the U.S. dollar weakens. Again, basically because you can buy more dollars back when after you convert it. And then the same falls for when the dollar strengthens, a U.S. investor is hurt by that. Currencies are volatile and the risk is meaningful. So when you look over any period of time, especially short periods of time, the currencies can have a big impact on your total return. However, that volatility from investing in multiple currencies actually is a diversifier, because the currency can move in a different direction than the stock market of that country. So like I gave examples before, just because the stock market in Germany may go up, it doesn't mean that the euro is necessarily going to go up. So those differences, that uncorrelated nature of the currencies, actually is a benefit for an investor because of the diversification aspects. Currency is said to be a zero-sum game over longer periods of time. And the notion there is that, 1 year you may benefit from currency, the next year you may get hurt from currency. But over longer periods, it tends to equal out. And so that's why you have a lot of your active international equity managers saying that they take currency into account when they look at whether they want to buy a particular stock or not. However, they don't really take into account how the currency of that country is going to move. So the currency effect over longer periods of time tends to be a wash. However, there is trends that certainly occur over periods of time.
That's a key point, though.
if you're saying, if one thing you're saying is we need to be hedged currency, but over the long term, it doesn't matter, what does the data show? I mean, are we concerned about the interim fluctuations more than the long-term trend?
Yeah, I think that's some of the things that we're going to get into here, is that,
I'm just trying to help out this presentation.
yeah, over the last number of years, it has been somewhat of a wash. However, the trend has been that the dollar has weakened, and we'll see that you've actually benefited over time. But one could make an argument that that could change in the future. And then the two German stock examples here are similar to what I gave you at the beginning. In 2000, the German stock market was down 7.5%. The euro depreciated versus the dollar. So that was a deterrent for a US dollar investor. So the actual return was a negative 13.8. 2 years later, German stocks were down 44%, but the euro appreciated 16%. So you benefited from that currency translation, and your return was only 27.9. The next couple pages look at some of the past performance of currencies over time. So page 4 shows a number of different currencies over the last 5 years. If you end up plotting above the 0% line, that means that the dollar weakened against those currencies. So Japan, most significantly, was a currency, the yen, that appreciated versus the dollar. The two other larger currencies, the euro was weakened against the dollar by 9.83%, and the pound, the UK pound, also weakened against the dollar, down 18.34%. You also see that there is a volatility over the last 5 years, so from year to year, quarter to quarter, it could have a change. But at least for these examples that we're showing here, it's about half have been positive versus the dollar and half have been negative versus the dollar. Page 5 gets to the chart that I was talking about with David, in that you see here over the last 1, 3, 5, 10, 20, and 40 years, in every different time period, the currency effect has been a positive for a U.S. investor. Over the 40-year history, it has added 1.73%, which has meant that the dollar has weakened over that time on an annualized basis. However, in the most recent years, it has not been as high of a number. And potentially that trend could change. Well, let's take a look at volatility on pages 6 and forward. So here what we're looking at, yes?
So the MSCI EFA returns include all the currencies in the previous chart? On 4?
Yeah.
Most of them anyway?
Most of them, yeah. Yeah, there's also some emerging countries in there as well that would not be in the MSCI EFA. So on page 6 shows the effect of hedging and its effect on reducing volatility over time. And so the green line represents the EFA index in dollar terms, which means that it is not hedged. And then the red line represents the EFA index hedged, 100%. And so over a good amount of the period, it doesn't actually reduce volatility all that much. In the period 1995 to 1997, hedging actually did not reduce volatility. However, over the last 5 years, if you had a hedged portfolio, it would have had significantly reduced volatility over that time period. However, as we saw on the previous page, over the last 5 years, you still benefited from the currency effect on your actual returns, but the volatility was a much rockier ride over that 5-year period.
Bud, what do you think the cost would be to hedge something if I add hedging costs onto this prior page, or take it off the prior page's returns, what do you think the cost?
I would say in the neighborhood of 10 basis points.
Okay.
The next page is a chart that basically is rolling returns over 5-year periods, looking back over the last 20 years. So every quarter we roll another 5-year period. And this shows again the effect of hedging on returns and volatility. And basically what it's showing is that the hedge portfolio has averaged slightly less risk and slightly less return. Again, this is the equity market, non-US equity market measured by IFA, hedged and unhedged. So you are getting reduction in return, or reduction in risk, but you also are losing some benefit of return on average over the last 20 years.
And Bud, does that reflect the cost of the hedging in the numbers, or is that without the cost?
That's without the cost.
Without the cost, thank you.
Now, page, yes,
Would bonds be addressed at some point?
next page. Yeah, it is a different story when you,
We're one step ahead of you.
They didn't go through this prior.
Yeah.
page 8 does reflect the same chart of 2 pages back, but here we're looking at the non-US bond market, the Barclays aggregate, global aggregate ex-US, so it's non-US bonds. And the maroon line is the unhedged portfolio, and the red line is the hedged portfolio. And in fixed income land, you see significant reduction in volatility from hedging a fixed income portfolio. And there are 2 major reasons for that. One is that in fixed income, there is a less of a total return, and so the currency makes up a larger percentage of the total return. So if you are hedging away the currency, you are certainly going to reduce your volatility because the currency makes up a larger portion of that return. The second reason is that when you just take a look at the fixed income markets around the world, they are more highly correlated to one another than the equity markets. So in the equity land, the euro could be up, the yen could, or the German stocks could be up, the Japanese stocks could be down. There's a lot more volatility and uncorrelated markets in equities. In the fixed income land, they tend to move as global interest rates moves. Duration is a bigger part of the movement of fixed income markets. And so the currency has a much bigger effect on fixed income than it does in equities.
But on the fixed income markets, the costs hedging about the same at that point, or are they a little higher?
It's my understanding about the same.
And on this illustration, the benchmark you use, it doesn't include emerging market bonds, or does it?
The global ag, Martin, you may be able to correct me, but I think global ag has some exposure to emerging markets. Does it not, the global aggregate?
Yes, yes. In fact, the current benchmark that we have right now, the core fixed income, and even the Barclays Ag has Yankee bonds in there that include emerging markets, but in dollar-denominated form. So yes.
Essentially, the investment grade. There's certain credit. I just bring it up because I have to wonder if there's a different, risk-reward trade-off, with investing in emerging market bonds, the hedge versus unhedged consideration.
Whether the volatility increases with the emerging market?
Yeah, if there's more, I don't know, synergies play, because those currencies have different dynamics than you know, the euro or the yen or some of the other.
I don't know for sure, but my guess would be that a hedged emerging market portfolio would still have the significantly reduced volatility.
But probably at a reduced return.
I believe it's more expensive to hedge in emerging markets substantially, is it not?
In the emerging markets, it would be, yes, but between fixed and equities, I don't think there's a big difference. Mark just made a good point to me that because the hedging of fixed income markets do have a big effect on volatility, you typically see your active international fixed income managers do a lot more hedging than your equity managers because of the significant reduction in volatility, and because I think fixed income managers are taking into account sovereign debt, sovereign currencies, and doing a lot more fundamental analysis as it relates to currencies in fixed income than they might do in equities. Page 9 is another way of showing the risk versus reward of a hedged versus non-hedged in the fixed income markets and the international fixed income. And again, significant reduction in volatility from a hedged fixed income portfolio versus non-hedged, with basically no give up in return here. The average over the 20 years on a 5-year rolling has been about the same return, but much less risk. So what are the ways to hedge a portfolio if you are interested in taking some of the volatility out of the markets? Page 10 outlines 4 areas. One is the unhedged portfolio, which is basically what you currently have, and that is that you are investing in the non-US markets by not hedging back to the dollar. And so the manager and your fund itself accept the currency effects, and you will benefit when the dollar weakens, and you will be hurt when the dollar strengthens. The passive hedge seeks to remove either all or some of your exposure to currencies. And basically a passive hedge says that, all right, we know that your portfolio has about 16% total in non-US equities. We want to pull down the currency effect down to, say, a 10% exposure. So you will hire a manager to passively hedge down to a certain percentage. And that could be, you know, down to 10%, could be completely eliminate your currency exposure. But they are, you know, looking at your current natural exposures and then creating some hedge against that. An active hedge is somewhat similar to a passive hedge. However, where you might want to reduce your exposure from, say, 16% down to 10%, it will not be a straight passive elimination. It won't be a static percentage. Maybe over time, or the goal is to reduce by 6%. However, you may look to overweight one currency versus another, and move that dynamic hedge over time. And so you wouldn't necessarily have a complete static elimination of your exposure, but be a little bit active over time.
Is the key of being active is it always to reduce the exposure, or is it also to generate some return?
It's both. It's both. So you're looking to overall reduce it, but take advantage of where a manager might see the currency
Strength and
moving.
weakness is a sort of more tactical.
Right. And then the fourth version, which is an active overlay, which can come in many different forms, but is basically a manager that is going to act more like a hedge fund. And they can significantly overweight a currency, underweight by shortening a currency. They can work with your current natural exposure. Say you have 16%, they can work around that. Or you could say, I want to have a goal of 0% exposure, but then I want this overlay on top of it. So it can be utilized in a number of different ways, but it is significantly more active than the previous two examples.
And Bud, would that be a way to manage currency exposures? Or would that be treating currency as an alpha source, which are kind of two different things?
Yeah, that example is more of treating it as an alpha source. However, you can use it to, you can hire that same manager to hedge some of your exposure, but then look at it as an alpha source. Page 11 just sort of gets at the passive hedge. And as we talked about, there are different percentages that you can hedge away. The 0% hedge, as we talked about, was basically what you currently have, no hedging involved. There are many plans that talk about hedging away a certain percentage. 50% is highlighted here. So basically you're taking away some of the volatility. You're still exposing yourself to half of the movements in currency. And then the 100% hedge is obviously looking to reduce that short-term risk of currency movements, and may be a tactical play as well if you just feel like the dollar is going to strengthen over a bucket of currencies going forward. However, the third bullet point on the 100% hedged is important, because when you take away the currency movements, especially in non-US equity, you are taking away some of the diversification benefits of investing in non-US stocks. So the correlations to US stocks will go up. And so it will move more in concert with how your US stocks move if you have a 100% hedged portfolio. And then the last bullet point also plays through that, in that it may impact asset allocation, in that if you model non-US stocks to have different risk rewards, it changes those risk rewards over time. The next page gets at, so when is the right time to consider reducing currency risk? And it's our opinion that although many would like to make the decision based on where they think the dollar is headed, whether it's going to strengthen or weaken, that we feel that the total exposure that you have to non-dollar currencies is the bigger issue, and that at a 16% exposure that you currently have is not all that high. In relation to other plans, you have a lower exposure to non-dollar currencies. And we do like the diversification benefits that you do get out of that exposure to non-US currencies. And so, although this is not, we haven't really charted it and looked at specific risk rewards of it, we feel that about a 25% exposure to non-US or to non-dollar securities, at that point you should look to consider doing some sort of hedge.
And you don't look at the equity markets and the fixed income markets exposure combined, because their fixed income manager generally already hedging the currency risk?
Yeah, well, the comments here are more at a strategic total plan level, but what you just said is accurate in that you should then break it down into the various asset classes and look at what your managers are actually doing. And in the fixed income land, you would certainly look to your managers to hedge there first because of the reduction in volatility. And then in equities, that would follow next. However, the last bullet point points out that with the NYCERS plan, the basket clause limits may come into consideration because of the use of derivatives in order to carry out a hedging strategy. And so if you want to hedge away 10%, my guess is that 10% exposure to derivatives in order to hedge away the currency is an account towards your basket clause. And so this is an issue that is problematic for NYCERS.
Put another way, since we're working our way up to the basket clause limit, it's very expensive to put a hedge on. Because the opportunity cost of, say, I'll make it up, $1 billion of nominal hedge costs you $1 billion of private equity allocation. So if you look at your asset allocation, I think private equity is supposed to get you 9%. That's the implicit cost of not putting $1 billion into private equity, but putting on this hedge. Very expensive because of the basket limitations. If we had more room in the basket, it'd be different, but we're kind of working our way up to the limit. I think we'll probably talk about that next, but it's sort of a peculiarity of the city pension funds that we have the basket trade-off to consider when we think about something as simple as a hedge.
And finally, if you look at page 14, what are other plans doing? The majority of plan sponsors that we work with and talk to have discussed hedging, but because of the trend that we saw on that page, where over the last number of years the exposures to non-dollar currencies have been additive, very few plan sponsors have actually implemented a hedging strategies. However, they're certainly adding more non-US, non-dollar exposures to their portfolios over the last 5 years. And just as we talked about with NYCERS, as that percentage rises, I think we'll see more plan sponsors looking to do some form of hedge. A number of plan sponsors have, put in different guidelines into their investment policy, and so they're prepared and ready to hedge when they think might be the right time. And then there are certainly, both on the fixed income side, but also on the equity side, where they have allowed their managers to defensively hedge. So in summary, I would say that it's always a good idea to take a look at ways of reducing your volatility. Hedging is certainly one way to do that. We would suggest that you don't really try to time the market by anticipating the movements of the dollar versus other currencies. But as that exposure to non-dollar currencies increases, we think the risk of that volatility is at a point, in the 25% range, would be at a point where you might want to consider hedging.
What's the expected return of if you were just to have a currency manager as an alpha source to get to?
Yeah, it's usually.
If you're going to use it in the basket clause, you're going to want to look to see whether or not you're getting the type of return that you expect private equity versus hedge versus hedge funds.
Yeah, it's typically a absolute return type of T-bills plus.
Although I would volunteer that it doesn't necessarily have to be an alpha source, because if a good currency overlay manager is eliminating unnecessary volatility, then that frees up room elsewhere to, take risk and be rewarded for it. So I think that, this sort of hurdle that needs to be passed in order to consider hedging may be a bit limiting from that standpoint.
One of the other sides of it is, so if you go back, so we're an investor in something as simple as a company. Say, take your example, it's a German company. So we have a money manager who's picking German equities, and we have a German company that's probably doing its own hedging at the company level to get it back to euro. So if it's Mercedes-Benz and they're selling cars throughout the world, they're putting hedges on to get it back to euros. Our money manager is picking Mercedes-Benz as a euro-denominated stock to fit inside his portfolio to maximize his portfolio. So he's got euros and he's got yen and he's got whatever he has inside his portfolio. He might be putting hedges on. And then for us to overlay on top of that, you sort of could have 2 or 3 different hedges going different directions with different agendas. So it's not really like you're doing it in isolation. So I think Callan's approach, which is consistent with our other consultants, by the way, is, it's not such a bad thing for the first 15, 20, 25% of your portfolio. At some point, it's a real investment. You need to really, really pay attention. I would also tell you that these are pretty strange times. Not that it seems like we have an awful lot of strange times in the last 4 or 5 years, but these are pretty strange times when a country like Japan wakes up in one day and surprises the markets and says, we're going to depreciate our currency by 50%. So if you had some hedges on, you just get crushed. And again, they have, in theory, our equity managers are doing something with Japanese stocks. They probably didn't anticipate that, but there's something going on in our portfolio already that has to do with Japanese equities. And you have the monetary authorities all playing with their currencies, probably depreciating them all because they have so much debt. So I think it's really, really difficult to design a strategy today, some sort of overlay that we think cures some ail. It might hopefully reduce volatility, but again, all the returns that we look at when we pick managers are based on dollar returns. So if you go to that page, that's part of our return that we've picked up might be currency, but we made that decision to hire those managers based on their returns, which had some combination of currency and stock picking, and we like that combination. So I just think it's really, really hard to sit and decide something that's part of the equation that we kind of inherit every time we pick a set of managers for international stocks. Again, when we pick emerging market equities, we know it's more volatile. When we sit down with Callan and we come to boards with recommendations, it's trying to pick the best managers that manage equities in emerging markets, taking into account the currency inherent therein. So to put something over that may or may not destroy what you're actually trying to do, because again, we're looking at their track record in dollar terms over 1 year, 3 year, 5 year, 10 years. And the currency is already embedded in what we're looking at. So it's very hard to just say, well, let's pick out the currency and try to do something with that. So again, I think Callan's conclusion is right. It's a good thing to understand. It's good, particularly to just keep in mind the chart that Catherine pointed out as to where our currency exposure is, right? The biggest piece is in euros, but it's only 20% of our portfolio. Okay, so now it's 20% of 16, which is 3.2% is in euros. That's not so bad. You look at it and say, well, that's not so bad, but then, there's a lot of noise going on in Europe with the euro, but if 3% of our exposure is in euros, it doesn't seem like a big bet on euros. Having said that, we got euro exposure all over the place in everything we do, because every equity we own, the management of that company is worrying about currencies in their day-to-day business. So I think Callan's done a great job pointing it all out to us, but I think the conclusion is interesting. Pay attention once a year, check the patient, but don't do anything.
And I agree with Larry. Thank you very much, Callan and BAM, for this presentation. I just want to go back and check to ensure that this is consistent then, this conclusion that Callan has reached and that we agree is reasonable, is then consistent with what's in our investment policy statement today. So if we look back at page 10, it would seem to be fairly consistent that our policy today does say that we basically believe that we should be unhedged at the total portfolio level, which means that the second bullet point, the need for a passive hedge, wouldn't have to be incorporated in our policy. And we do allow for active hedging on a manager-specific basis. So we do say that our managers, if they believe it's prudent, have the ability to make a decision to hedge on their own. And then again, the active overlay is not something that we have decided to do as an asset class, so we wouldn't want to consider that as part of our IPS. I think the one thing that seems to maybe be a little bit fuzzy in the IPS is how do we address when a manager themselves doesn't have the ability to hedge currency or doesn't feel like they have the ability to make currency hedging decisions. And this came up with a manager recently back in December. It was actually a fixed income manager, not an equity manager, where it was primarily a euro-based investment for a very finite period of time, not a long-term investment that would, be in existence over currency cycles. And we looked at our IPS, and it seemed as if our IPS didn't give the plan the ability to make a hedging decision in this particular case. So perhaps we need to just make an adjustment to the IPS to allow for some sort of hedging on a one-off basis when we feel like the risk-adjusted return could be improved.
I've read the IPS. You read the IPS lately? And?
Not exactly sure what Janice is referring to, but we'll check the language and see what the vagaries are.
Yeah, if you could maybe just come back to us quickly at the next meeting and let us know if we need to make any adjustments to allow for that sort of situation. Terrific.
James, maybe I should just comment, because you did look hard at that trade. One-off hedges, and I'll try to avoid jargon, but I'm going to have to get into the weeds a little bit of how one hedges currencies. Currency markets are incredibly deep and efficient because it's an interbank market. They all have ISDA agreements signed with one another. They have credit support annexes. They post collateral. We have none of that machinery in place. So a one-off hedge means the hedge counterparty has to face a special purpose vehicle, a non-recourse vehicle that cannot post collateral, has not signed in ISDA. They charge for that. They charge through the nose for that because, let's say, we anticipate earning 200 over LIBOR or something like that in the SPV. They want their share of that because they're facing the risk of an SPV with no recourse beyond that. It also is a specific trade with a specific entity. So if we do another one, it's another trade. Even if the currencies go the opposite directions, we don't get to novate them, we don't get to net them. It's a horribly, horribly inefficient use of the currency markets to do one-off hedges of particular trades. If we really want to look at this, we have to get ISDAs in place, we have to get the legal department to take a more benign view of derivatives, and we have to have a bigger basket clause so we can do it. If we're doing it as one-offs with SPVs, the cost will be prohibitive.
And so that is inconsistent then with the 10 basis points that we were talking about earlier, it would seem?
10 basis points is in a bank. They're not assuming that we're dealing with an SPV non-recourse.
Is that right?
You guys, whether the SPD one-offs, yeah, I'm not familiar with doing it one-offs. I'm just, what the manager will charge to do an overlay is approximately 10 basis points.
So I guess today the way it's approached is that if we have an investment that is put in front of us, that is a non-dollar investment, and the volatility of the currency unhedged is such that it produces a risk-adjusted return that is unfavorable, our choice today is to either say yes to the investment or no to the investment. We don't have a third choice that says yes to the investment and hedge. And I guess that's what I'm trying to address, is does our IPS force us to either say yes or no, or does it give us an alternative?
I'm not sure if that's right. At the time we made that investment, we had discussions about hedging, the board decided not to hedge, and boards can amend IPSs at will.
Right.
So if there was nothing in the IPS that we were aware of that prohibited the board from having the conversation and making the determination it did. But we'll check the IPS wording, but they can always, the board can always change IPS if they think there's something inherently in the way of making a good investment.
And maybe the solution is just to simply, when an investment is presented going forward, to have a thorough discussion and an in-depth discussion about the risk-return effect of currency and, hedged and unhedged. Perhaps that's the way to address it.
Janice, I do think that maybe having a discussion at the time that investment's brought before the board is fine. But the idea that the board could interject expertise sufficient to make a hedging or non-hedging decision relative to the manager that's being hired, I think is asking an awful lot. I think the board, as you know, and I've said this many times, should try to stay up at the policy level and decide on hiring people who then are required to carry out mandates, and you give them a mandate. And if you want to give them a little flexibility, give them a little flexibility, but don't, I think the board shouldn't be expected to be experts on hedging as to whether to have a hedge on a specific manager or investment.
I agree. I'm just addressing an issue where a manager doesn't have the ability to hedge, and how do we approach
By
it?
the way, I think that's completely irrelevant. If the manager doesn't have the expertise, that's fine. They don't have the expertise. Either hire them or not hire them based on what it is they're supposed to do.
Right.
If the policy says you want to hire people to invest in foreign markets and make the best possible funds, it would seem to me that you ought to hire them for that. If you want to have an overlay of currencies, there's a question whether you should ever do them one at a time. If you want to have an across-the-board hedging process, that's fine, but I could argue you then ought to get into Callan's point about maybe you ought to go back and review whether you ought to have any non-US dollar denominated investments at all. I don't think it should be at the individual level. Managers bring their expertise, and it's either good enough or it's not. And today, I don't know, I'm a skeptic, as you know, I'm often skeptical about things. I'm skeptical about 10 basis points. I'm skeptical that that isn't a lot more, and then subject to being even worse when the people who run it aren't as good as the theoretical models suggest. I think generally the hedging thing, you invest it overseas to get diversification and the benefit of what the rest of the world can offer. Failure to take account of that and then revert by hedging it back to dollars, spending a lot of money to do so, well, it may employ a lot of people on Wall Street, but I don't see how it helps the fund.
Thank you, Bob. And I think really our main goal is to ensure that we do get the best risk-adjusted return for the portfolio as a whole, and allow that the IPS enable that. John?
I have a question, and maybe I'm being naive on this, but we're a long-term investor. We're looking to do this for the next 50 years, 40 years, 100 years, for the benefit of our members. If hedging is a zero-sum game, which is where we started with, but it's going to cost us at a minimum 10 basis points, why are we doing it? If in the long term it's going to end at a zero, but cost us money every year during the process, it doesn't seem to be an effective use of our resources to me. Unless I hear otherwise, I'd like to know why. Maybe I'm just being naive on this.
Well, it's the short term versus the long term is the answer. So if we're in non-dollar currencies over the long term through all market cycles, through all currency cycles, we probably don't need to hedge because we're getting, it's a zero-sum game. However, I'm thinking specifically of when we go in for a very finite period of time and then come out. And we have no way of knowing where we are in the cycle at that point in time. So I'm saying if it's a finite investment time, a fairly short investment period, at that point, you look at the risk return of the portfolio that it's going to produce. If the currency hedging volatility is going to swamp the return over that very short-term period, today, all we can do is say, yes, we want to make that investment, or no, we don't want to make that investment. We don't have that third choice of saying we can hire a currency overlay manager to improve the risk-adjusted return of that short-term investment. And that's really all I'm saying. Just let's make sure that, yeah.
I'm not casting aspersions, I'm just trying to understand.
Yeah.
Well,
And I'm
John
sorry-
has a reasonable point, because if you view the portfolio as something that's long, long life, like 50 years, and you take something as simple as private equity, so say we want to invest in one private equity fund that's euro denominated. Those assets are going to come and go. But if we view our private equity portfolio saying we want to get to pick a number, 2% in euro, that one fund may come and go, but it's going to be replaced by another fund that comes and goes. So that over time, you're going to have 2% in euros. So to your point, you don't have to hedge that one fund investment. We had a conversation, a long conversation with lots of analysis and lots of consulting work about should we hedge every drawdown that comes from a European private equity firm? And the answer is, of course not. It goes back to what Calvin was saying, because it's in and out, but over time, you're going to have a euro exposure. So if the answer is, it's going to be 2% in private equity is euros, leave every single investment alone, because you're going to have this 2%. To your point, all you're going to lose is the 10 basis points each time, which John agrees correctly costs more. So you do have to always come back. You can't get lost. I think it's right. You can't get lost in each individual investment. You got to take a policy decision. The policy is we like currency exposure over the long run, and not try to get so far into the weeds that you're making believe you're going to hedge each thing, because you're going to get smacked. You're going to get caught each time. Some good, some bad. Anyway, we probably talked about this.
Probably.
Probably.
Thanks, I'm still trying to think in my head.
Leave it alone.
Yes, okay.
Until it gets so big that your portfolio is now a currency portfolio,
Okay.
which they say is 25%. We're at 16. But it's a good thing to talk about every some amount of time.
Information is a good thing for the board,
Right.
except when there's too much information.
Or confusing. Okay.
Thank you.
Thad? Where's Thad?
I'm down here. You're welcome, Bob.
You want to give a basketball update?
So at the last meeting, BAM had informed the board that as a follow-up to the presentation that we'd given in January, where the board voted to pursue seeking state legislation to increase the basket to 35. The mayor's office requested that we have a meeting with their folks to flesh out some questions that they had. We had that meeting, and at this point, I think it's over to Janice to see if there's an update as to where the administration might be.
Well, we thank you for the meeting.
I just mean one thing, Pat, that's sort of you and I talked the last meeting, that's the crux of the question. I want to make sure that I've captured the question correctly. Thank you.
So as we discussed last time, we did have a meeting with the comptroller's office, and we thank you very much for that meeting and the information that you provided. And so we're now just waiting to review any legislation that's proposed. I think the board has voted on this matter. So I think
To the
now,
extent that you did receive a draft back in April, beginning of the month. This is still April.
so has that been proposed? Where are you in that process?
So I would tell you that as the board knows, the conversation that we gave, and I think you're kind of aware of this, Janice, that the concept was that the board would work together with not only this board, but the other boards and the various stakeholders, including the administration, so that we work collaboratively. So the question that we left the board meeting with was sort of where the administration was on this issue, not where we as a board were on the process. So I think we're turning the question around to a way that's in a way that I don't think the question was structured.
We, I guess I'm first unclear of what we're going to work collaboratively on, because I think have the boards all voted now in favor of a change from 25 to 35%? So there doesn't seem to be any additional work to be done. I think that the boards have voted. And that, as far as I know, you're just talking about changing one number. So in terms of collaborating on legislative language, I'm not sure what that would be.
So I would go back to the meeting that our office had with your office, and, you know, I'm also mindful of the calendar that we're in May, and, you know, members of the board who know the legislative process better than I do will tell you that it's getting very late, and I think that I would find this conversation a little disheartening to the extent that when I think we had the meeting in your office, the question that we raised was, would we be working with your office to collaboratively move this forward? So I gather from what you're telling me today, that's not sort of a question that you can answer.
And no, actually, that question didn't come up during the meeting at all. We thanked you for the information, but there was no discussion about working collaboratively. As far as we know, you know, you're proposing a change from one number from 2 to 3, and are you looking for us to help with further amendments to that language?
So I guess I would tell you, I would respectfully disagree as to the, and I don't want to take all the board's time, as to the nature of our meeting where we discuss sort of next steps. But I believe that when we left the meeting, that was sort of what was on the table as to working collaboratively with your office, the board, and the various stakeholders to move this forward, and that's in essence why we're waiting for a response. So I would tell you, in my mind...
That was not part of the discussion. So
I would respectfully disagree, and
Yeah.
so I think, you know, I have my answer today. I don't know if any board members have any follow-up.
yeah, I know that this is something that the comptroller was going to spearhead with the endorsement of the boards. I think you've had your endorsement from the boards on the change.
Again, I don't want to take all the board's time because I think we have the answer. I would tell you that the notion of spearheading, I believed, and I believe our meeting sort of kind of, that came out in our meeting, that the idea of was working collaboratively together, and I have my answer today as to where you are, and as I said, I'll turn it over to any of the board members who have any other questions. So I think it's unfortunate that we have a fundamental, you know, disagreement as to what occurred at not only this board, but the other boards, but also at a meeting at your office that you requested. But as I said, I think you've answered my question today, and I'll turn it over to the other board members.
Where are we exactly with the current basket clause? What percentage are we at?
If you look on page 100, don't look. See the very bottom number?
21%.
Yeah, the 4% is what we have left. And kind of the way, I mean, this is as funded. So, you know, as you know better than most, markets move, right? So you get the denominator effect, right? So we could find ourselves less than, yeah, right, right? You can move up. We also have a couple of things that I would tell you. So say you can have a negative denominator effect, which is the fund gets smaller. Therefore, the number goes up. We also have two things in place that we used to not have that can pile on, if you will. One is we have opportunistic fixed income. So if the stock market goes down, we have capital out there that can be called to take advantage of a bad stock market because the bond market might be going down as well. So you have the denominator go down, you have the numerator go up. So you can think saw it twice as opposed to once in the old days. I'm actually less worried about the undrawn capital in private equity, although if it's lasted a while, you have that as well as real estate. Because again, if the market's really bad, I don't think those guys would be drawing down money. I am worried about the opportunistic fixed income. Same thing, the hedge fund money is out there, so that's not an incremental effect. But we do have a thing that's out there that can bite us opportunistically, which is good. And the denominator effect.
Okay, so would you say, Larry, Callan, that that's a margin to be concerned with, this 4%?
We steer the bus we get to 23%, we're kind of done.
And how quickly could we get to, I mean, it could.
You can sell, I mean, you can always liquidate things here and there to fiddle around with it. So, Martin, help me with the definitions. High yield bonds.
Effectively, the release valve, so to speak, would be the non-US equity portfolio. That would be the most liquid basket of securities that you could sell quickly.
So,
And
well,
when- so into
it
that-
seems like it would be important to get to 35%. I'm just trying to understand the dynamics of it.
If we do this legislative year, you sure as hell better move now.
David, and I guess I would add a couple of things. The asset allocation policy that you've adopted, and this is to Larry's point, that ultimately you're pushing toward, as the others are funded, used up virtually all of that 25%. So that's one part of the answer. The second part is what Martin referred to, and we actually, we didn't, this didn't happen, but it came close back in the 2008 market crash, that the denominator effect almost forced issues. And the third part, the part we'll talk about in just a minute after this, is that the 35% offers significantly additional flexibility that then improves the diversification of the fund. So there's
They need to actually
those
go
three
through and
aspects.
redo the asset allocation mix and look at what else is out there to invest in. So then, if we've adopted, and you gotta help me with this is a political question. If we've adopted that we wanna go to 35, why don't we put legislation up there to begin this process to get to 35%?
So I think you raised a very good point, David, just sort of the history. When you look at where we were in 2011 in terms of adopting the asset allocation, the assumption was all along that we'd move to 35, and I would kind of encourage folks to take a look at the minutes and to see the comments that all the board members made about going to 35. So to the extent that I would tell you that we've sort of lost some time for a number of different reasons. And as far as this legislative session goes, we've now sort of, we're at almost May now. To the extent that it is late, I believe it will be the thought of our office that strategically it may be better to bring that back in a more opportune time vis-a-vis addressing the legislative questions in a strategic manner. I think it's a disappointment that the
But I'm not sure why we missed it, though. I think if we've agreed as a board, and then I hear police, fire, teachers, I don't know, Board of Ed, let's just say everybody agreed. So I'm missing a point why we didn't put legislation in at the appropriate time, whenever that is, and I don't know what the appropriate time is. It's way above my pay grade, but, and have we absolutely missed it for this session?
I think that the strategy behind it, to your question, was that we'd be working together collaboratively. So there was this period that was, I would tell you, was sort of lost. I think given where we are now in the calendar, it's our view that we need to regroup and sort of strategize as to where we are, since we don't necessarily have that, we won't have that support of all the parties at the board.
If we, if we do it the next legislative session and we become right up against 25%, we're in a real critical position, it seems to me. Because it may or may not go through, right? I mean,
To Martin's point, we won't push the numbers in normal course, we'll stop. And B, to Martin's point, if we think for whatever market action is happening, we'll dial ourselves down by selling
But is that good
international
fiduciary
equities.
responsibility right there? I'm worried about, from a policy, from a.
Unfortunately, it wouldn't be our fiduciary responsibility because it's a statute that says we must.
It's a law.
Well, I find this major disappointing, I have to tell you, because we were here discussing this, I don't know, was it January of 2013? We had discussion on
We had discussion.
increasing it to 35%. And I know that the representative from the Bronx, who was a former assemblywoman, knows the system very well, as do I, because I've been lobbying for thousands of years, it seems. And the bill isn't in yet, but one could put the bill in now. Not every bill passes in the session in which it's introduced. People need to be educated about what the bill does. You just don't go to leadership, you go to all of the people that you can reach, assembly members, senators, and explain the bill. Now, the folks are in the common fund. Pensions are, for the legislators, are in the common fund. So I think you have a real talking point here to people, is self-interest as well. But the folks may not understand all this about alternatives and that one must increase the basket. So you would educate people. That's what lobbyists do. That's the job, educating people. So I would still like to see the bill go in. One never, ever knows when a bill will pass. A big example for me, and it's my proudest moment really as a lobbyist, was the paraprofessional pension bill. It went in April. And it passed in June. And it was a magnificent bill, I think, because it gave the people who were working in the public schools a pension. And many of them had been on welfare prior to taking the job. So it was an extraordinary moment for me. But the point is that you just don't know. People told me that bill wasn't going to go, and it did go. And that's the same thing with this bill, if we could put it in. And I guess because the city is not on board, it would appear, in terms of a collaborative effort, maybe the comptroller's office might consider putting it in. I would hope so. I would like to see the bill go in. I see no reason to sit around here and twiddle our thumbs, and then we talk about infrastructure, we have some meetings on infrastructure, and then how are we going to do it? Is it an alternative class? So I'd like to see this happen. I'll say no more.
You know, it's funny you mentioned Controller's Office. I was with Vicki Fuller last night, who's Larry's counterpart, the CIO. We had this very discussion on increasing to 25%, 35%, which she was, you know, head over heels supportive of, and in sort of, you know, her biggest, you know, her biggest wish would be to have go from 25 to 30, because I think they're in the same boat with us. They're looking at real assets, they're looking at all sorts of things. I don't know where they are percentage-wise, but I assume they're, you know, like us, close to bumping up against it. So it would seem like there's relative universal support within the pension, New York State pension community to go to 35%. And I literally, this last night, we had this very topic discussion.
What will it take to move this forward as of this day? How long does it take to write a bill?
You may.
No, I'm just, how long does it take to drive up to Albany? Get a ink stamp, find a sponsor, have a sponsor. I mean, this is something that we voted for. District Council 37 supports this, so I'm willing to help out. I live in Monroe, New York. I'm very near Albany.
We'll give it to you.
Yeah.
Save on gas.
So we certainly appreciate the majority of the board's support, and we will circle up some on strategy going forward, and reiterate our disappointment that when you look at the sort of the context of these conversations going back to 2011 and the asset allocation and comments that were made by board members, that this support's not there, but we'll regroup and return to this discussion.
Great.
Thank you.
I have the support of the boards.
But not all the board. I understand.
Are you still waiting on one board? Is that the issue?
So the investment committee's met, we're waiting for the full board to do their official vote.
And when will that be?
For Burrs.
And what date, what's the date?
I don't know when the full board's meeting, Janice. I have to check for you. But the investment committee has voted in support.
Okay, great.
Thank you, Dad. So, The last thing on the public agenda is an update on the capital markets. Callan?
And I'll take this, we're gonna, if you go to your board package, this time, this was a color-sensitive, two-page presentation, so we're using the board package. And just to start on page 95, and this should be very short, but just a reminder, at the last meeting, we presented Alan's 2013 capital market projections in order to sort of compare where they were versus the projections we used when we did the asset allocation in 2011. And I think there were a couple of takeaways from that. First of all, that because the assumptions for the returns of the capital markets now are lower than they were in 2011, the expected total return for the fund in 2013 versus 2011 projections was down about 60 basis points, with very modestly higher volatility. And as a result, we then showed a sample asset allocation of what the portfolio might look like if the basket clause increased to 35%. So in line with our prior discussions. We were asked to just come back at this meeting with one additional update of what happens to the risk of the portfolio if in fact we did that. And so that's the only purpose of today. So if you just take a look at page 96, we're really just going to look at a couple of pages here. Page 96 in your book, we reviewed this page at the last meeting. And what it does is it contrasts under what's called target 25% basket clause, what your current asset allocation policy is that was developed in 2011, with what it might look like if in fact the basket clause was increased to 35%. And there are a couple of takeaways in this. First of all, you see a substantial drop in what's called broad domestic equity, in U.S. equity, a drop of 10%. And where does that go? It goes primarily into global ex-US, increasing that by 7.6%, because right now you're limited and constrained very much in how much you can have in non-US equity. So most of that, 75% of that drop in US equity goes to non-US equity. The remainder essentially goes into alternatives or illiquid, the category of hedge funds, private equity, real estate. So that's just, that was what we presented last month, just a rough idea of what might your policy look like if in fact the basket clause increased to 35%. So the result there is a much more diversified portfolio, as you can see, but we were also asked to look at the risk budgeting. So that, we go to the next page, on page 97. And there's a lot here, but I'll try and really just sort of talk you through. The diversification of the portfolio is one of your key objectives as we go through analyzing your portfolio, and we want to be able to continue to diversify. So that prior page we looked at were dollar allocations, but another way to take a look at is where is the risk of your portfolio? Recognizing that equity managers have more risk than fixed income managers, what's the risk budgeting of the current allocation? The result, if you think about it, is while public equities, US and non-US equity from the prior page, represent about 50% of your portfolio, if you take a look under the 2011 category and take a look at target 25% basket clause and go down to the area called public equity, you see that 50% of the assets equate to about 70% of the risk of the portfolio. And then if you bring in public and private equity, so bring in private equity into that, all of a sudden 57% of your assets absorb approximately 86% of your risk. So equity risk being much more significant than fixed income risk. One of the goals all along, back in 2011, was let's try and reduce to the extent we can the equity risk of the portfolio. You need equity in the portfolio in order to achieve your overall returns. So one of the first things I would tell you is that where we just referred to 69.9% under the 25% basket clause, Before that asset allocation change in 2011, your public equity risk was approximately 79%. So the asset allocation that added hedge funds, that added opportunistic, that increased very marginally private equity and kept real estate where it was able to reduce the public equity, or the public equity exposure by about 10 percentage points. So that was a big deal in order to do that. So now let's move over and take a look at the right side chart at 2013 and see the differences between the 25% basket clause and the 35% basket clause using 2013 assumptions. The first thing I would point to is under public equity, where it shows 70.3%. Notice that that's very slightly higher than the 2011 assumptions, and that's because expected equity volatility has increased at a greater rate than fixed income volatility. So very slight increase using 2013. However, if you take a look at the basket clause increasing to 35%, you see that if in fact you could add additional basket clause investments beyond the 25%, the public equity risk would decrease by another close to 3%, the public and private equity by 2 to 2.5%. So you've got to have a substantial amount of equity in order to achieve your returns. So you're always going to have most of the risk of your portfolio tied up in equity-like. However, to the extent that can continue to be diversified, that's a positive, which gets to the 25 and 35% issue. The second area is the very bottom point on page, on that same page on 97, is that the diversification of the public equity risk under the 35% basket clause is substantially more weighted toward a more balanced U.S., non-U.S. equity risk portfolio. So again, all of these are projections, but I think all of them play into sort of continuing to point to the benefits of an increase in the basket clause, the diversification, that you have the flexibility to use if you wanted to, if you had that additional basket clause issue. I think that the takeaways again are that it continues with a reduction of equity risk, continues with the diversification of equity risk to the extent you're able to use that the full 35% or greater. So I'll stop there. That was.
Would you add real assets to real estate also, or would that change if you? I mean,
David,
dramatically.
I don't think it would dramatically. We've already recognized, as we spoke about. I think the board a number of months ago expressed a lot of support for that idea of real estate being real assets. From our assumptions, there may be some modest changes or some changes, but I don't think it would have a significant impact.
Okay, I just have one question. You're saying that global ex-US rises to 37.2%, but earlier in the presentation that you did on currency, you were saying once we get to 25%, then we should be hedging. So
no, let me stop there. Yeah. No, it's a good point, Janice. I think the point we were making in the currency presentation is once you approach 25%, that's time to at least reconsider. It's not a recommendation that in fact you hedge. It's a time at which you take a look at that. But you're right. Increasing the basket clause, and from an optimization standpoint, if that increases global ex-US equity to 24.5%, and then you have other currency impact from other asset classes, you begin to approach that, then you also take a look at, is that part of, do we then take a look at currency as part of that? The answer may be no, but it's at least it's an issue to take a look at. And if you did, then there is potentially, as Bud talked about earlier, some usage of the basket clause for hedging purposes, which changes this to some degree. But I think all of that, are specifics that still don't mask the overall issue that the diversification, extra diversification that can be achieved by a 35% basket clause is beneficial to this fund.
We're also not signing up to this asset allocation today.
Exactly.
This is just an example,
This
right?
is an example, Larry, correct. Okay.
Any more questions? Thank you very much.
Thank you. I think that ends the public agenda.
Do we have a motion to exit the public agenda and enter executive session?
I make a motion.
Okay, do you want to second it, Larry?
That was it. I'm not allowed to.
Okay. We have abundance of motions and seconds.
No, somebody else.
So we are now in executive session, and we need a few minutes